Hey, how you doing? Tom Strano here. I want to welcome you guys to Forex Income Maximizer Professional Forex Trading Lessons, or FIM as I like to call it. Okay, I'm going to go over today some professional trading strategies. I'm really going to be focusing on Fibonacci ratios, numbers, and how to properly draw a Fibonacci retracement from a top and a bottom. These are very, very important levels. All banks use these levels as an indication of a shift in supply and demand, and they will trade accordingly to what's going on in the marketplace based on these levels. Okay, and the ratios are really, really important, so I'm going to divulge to you today the professional bank trading levels. Now, if you're completely new to trading, or you touched upon, trading a little bit, don't panic. I'm going to have a subsequent video after this actually showing you exactly what I mean in this video. But it's really important that you take some notes and you try to apply this on your own before you go off onto the other video. This way, you get a learning experience, and that's the whole idea here. Okay? Fibonacci ratios are really important. They are rampant throughout nature, from a seashell to actually converting kilometers into miles per hour. You can use Fibonacci ratios. So really they're just a sequence where you're adding the preceding number to the subsequent number, and you'll come up to the golden mean, which is 0.618. Now, if you're really interested in it, just Google Fibonacci. You'll find all you need to find about it. But in trading, it's amazing how uncannily accurate these numbers actually are. So what do we use them for in trading? Well, we use them for entry and exits, and they give us the ability to measure, certain trading entries where we can have a really low risk exit entry. So if we're wrong, we can hit the escape hatch really quickly, get out with a very low loss on the trade, and move forward. Because the objective of trading obviously is to protect capital first. Making profits is secondary. So we're always looking to protect our capital, and that's really, really important. Okay, so I'm going to go over today, right now, what the Fibonacci ratios are. Okay, and you can input these ratios in your Fibonacci tool that you have on your chart. But I would really prefer you guys to, after I give you this little mini lesson, to actually go and touch your charts. It's real important, because if you go out there, you go on your chart, you print it out, and you measure these legs the way I ask you to measure them, and then you actually manually, draw on your charts, touch them, these levels will stay in your mind, and when the market is reacting at these levels, you'll say, you know what, there's a fib level there. So you'll really be intimate with these levels. It's very, very important. So in your Fibonacci tool, you're going to probably have the same ratios that I do, except for the 786. I use 0.82. So I'm going to list these for you. Then I'm going to explain to you which I feel are the most important levels, and which the levels that the banks really look at, because that's where the action occurs. And we always want to be looking in the same spots that the institutions are looking at. We want to be on the proper side of order flow at all time. Okay, so if a level is breaking, a Fibonacci level is breaking, you can be sure that the big boys are seeing it, and they're also going to be reacting the same way that we're going to be reacting, so that we get on board and get on the train before the train moves. We don't want to miss the station. All right, so the most important levels that we want to look at are the 2, 3, 6. This is the first level that you're going to find in your Fibonacci tool. This is really what I consider a minor level. It's not really that important of a level. However, minor can turn into major when a marketplace breaks up above it or below it, and it starts using this level as resistance or support. If we are basically coming from a top and we're touching our 236 and it can't break through, well, we know that most likely we're going to be traveling back up to the point 382. All right, so the next level that we have to really be intimately familiar with is the 0.382 level. Okay, so you got your 0.236, you got your 0.382 level. Another, what I consider kind of a minor level, is the 50% level, or the 0.500. Okay, this is actually a Gann number. This is really where Gann said that the marketplace was in true equilibrium at 50%. Okay, but really I'm going to show you what banks really look at. This is kind of like a minor level to me as well, like the 2.236. The more important level is the 0.618. Okay? What generally occurs, and what you really want to start watching, and like I said, I'm going to show you this in a subsequent video on a chart where we actually set this up and we can look at it. You really want to look at the trading that takes place between the 0.382 and the 0.618. Okay? You need to start asking yourself some questions when the marketplace is tracking between these two levels. Okay? You got to ask yourself, are we making deeper bottoms and lower tops between the 0.382 and the 618, or are we making higher bottoms and higher tops? Because the definition of a downtrending market is a lower bottom and a lower top, and the definition of an uptrending market is a higher bottom and a higher top. So if that's occurring between the 382 and the 618 level, most likely you're going to be able to ascertain whether or not the market sentiment is bullish or bearish. Okay, and these levels is where most of the action occurs, between the 382 and the 618. After the 618 level, you have my level. It's the 82 level, 82%. I came up with this level really from an option trader at the bank, and there's a lot of lost motion in foreign exchange. So this level seems to work a lot better than 0.786. And it really nails some decent bottoms for you, so that we can basically trade the proper direction. 786 seems to get pierced around a lot and broken, and I don't like when marketplaces trade through certain levels. For me, they lose their validity. So the 0.82 is really a proprietary level. It's an excellent level to add into your Fibonacci trading tool. Okay. After the 0.82, we got 100%. That's a really, really important level. Okay, that's basically the full leg of the move, the full measure. If we break the 100%, we're going to be going to 1.382 is our next level. So we got 0.236, 0.382, the Gann level of 50%, 0.618, 0.82, my proprietary level, 1, and 1.382. Okay, so once these levels, if these levels are pierced, we have after the 1.382, guess what? 1.618. That's our next level. Okay, so we're going to add that. That's an outer extension level that you want to add. And then after 1.618, we got a really important number, and I'm going to put it right here because I consider it to be a magic number. It's going to be 2.236. Really important number. A lot of things happen at this level. Markets tend to reverse at this level, and you're going to be able to see that because once you put it on your chart, you're going to be able to go back and look at this 2.236 level and say, holy smokes, that was a really nice top or a really nice bottom. Market decided to turn around there, start trending back in the opposite direction that it's been at. After the 2.236 level, we're going to come to the 3.00 level. After 3.00, we got 5. Now, obviously, Fibonacci numbers go out infinitely, and you can continue on, but generally after you hit 2.236 or the 3 level, you're going to probably have to take another measurement and then redirect on your chart. And I'm going to show you all this. So, why do we want to learn this stuff? Well, like I said, we really want to be on the same side. We want to be looking at the same chart that most of the big institutional players are looking at. Now, there is a certain way to draw Fibonacci retracements, and we're going to go over that, and I'm going to go over that right now. If somebody would get me the eraser that's on the desk, that would be a good idea. And I'm going to actually draw for you how you can just toss it over. Thanks. Okay. How we go about drawing Fibonacci retracements. Okay, and I'm going to use an all-black marker. Unfortunately, I don't have red and green, but it's very simple. You have a Fibonacci tool, and you can use this Fibonacci tool as long as you put those levels that I put in that Fibonacci tool, and you're going to basically come to the same ratios that bank traders look at. And this is real important because you want to draw the stuff the same way that the banks draw the stuff. Okay, so how do you do that? Well, let's say, for instance, we have an uptrending marketplace. And the market makes a nice top, comes off a little bit. This this top here becomes a supply point. What does a supply point mean? It means basically this high is greater than the previous high, and it's also greater than the subsequent high after it. So this basically, this top could be in place. Okay, so this would be the first place we would start looking to actually draw our retracement levels. So what would we want to do? Let's just say that we had a chart that looked like this. And we're going to put our stuff back in history. Okay, when you're at a high in the marketplace, you need to go back in history to the left and look for a higher high, okay, which occurs right there. Okay, now when you find this higher high right here, okay, you need to find the lowest point in between this high that we just found, the recent high, and the previous high that's in history. And you're going to find this low is the point. So what we're going to do is we're going to measure the top of this bar versus the bottom of this bar. And let's say the top of this bar is 136.00 and the bottom of this bar is 134.00 euro dollar. Okay, that's 200 pips. And what we're going to do is we're just going to take this 200 pips and we're going to multiply by those ratios that I gave you. 0.236, 0.382, 0.500, 0.618, 0.82, 100%, 1.382, 1.618, and so on, okay, all the way down. Now, what you're going to do when you get these factors, you're going to just subtract whatever this amount of pips is from the high. So you're going to come and you're going to get your 0.236 level. You're going to get your 0.382. You're going to get your 0.50. You're going to get your 0.618. Now, what I was describing before was if the marketplace starts tracking between the 0.382 and the 0.618, if it basically starts, just channeling between these levels, you're going to want to start to ask yourself, am I getting higher highs inside this with a higher low? If I am, most likely what you're going to want to do, this is giving you an entry that you can basically try to buy as close as you can by this 618 level. Okay, so that because maybe you're going to be attacking the 382 and then going up higher to the 2.236 and then beyond. Okay, if the marketplace just zooms through the 618, most likely you're going to be finding your support at the 0.82 level. All right, now I'm going to go over all this again. I'm going to go over all of it on the screen so you can actually see it. But I just want you to get this down. You make a high. How do you know it's a high? Well, it's got to be a supply point. What is a supply point? The easiest way to know what a supply point is, if you take your three fingers and you put them together, your forefinger, your middle finger, and your ring finger, and you put them together, okay, and you put them up in the air, that middle finger sticking up is a supply point. The opposite side is if you put it down like this, that middle finger sticking down, the deepest one, is a demand point. Okay, so you want to find supply points, a high surrounded by two lower highs. That is your supply point. When you find that, you want to go to the left, look for the last time the marketplace traded higher or at the same price, and look for the lowest point in between those points. That's what you're measuring. That's the way banks measure Fibonacci retracements. They don't just do it arbitrarily. They're looking for supply points and demand points. So now, I'm basically going to go over for you the opposite side of this whole thing. And what's the opposite side? Well, it's when you're trending down and you create a demand point. What we're going to do here. Okay. I can make money all day with myself this way. Market's coming down. Makes a bottom. Okay, how does it make a bottom? Why does it make a bottom? Well, this low is less than this one. It's also less than this one, so that becomes a demand point. Okay, so what you want to do, let's just say we had a parabolic marketplace. Went straight up, came off. Okay, parabolically. What you want to do when you find this point after this, whatever time frame you're looking at, could be 1 hour, 3 hours, 4 hours, daily stuff. Okay, 30 minutes. I wouldn't really go below, 15 minutes because then it gets just too crazy. It's just too much chaos. What you want to do is go to the left. It's the last time you traded lower. So you got this point here, this point here. What's the highest point in between? It's this one. Okay? So you're going to want to measure this point against this point. And let's say this point's 145. And this point's 140. That's 500 pips. 500 pippies. Okay? And you're going to just multiply that 500 pips by guess what? 0.236, 0.382, 0.618, 0.500, 0.82, and so on. And then you're going to take those factors, whatever they are, and you're going to subtract it off the top. I'm sorry, you're going to add it to the bottom. Sorry, those are going to be your resistance points up. You're going to add those factors to the bottom. Okay, so you're going to get your 0.236, your 0.382, your 0.50, your 0.618. This becomes your resistance levels on the way up. Went to a low, went to the left, to the last time it traded lower. What's the highest point in between this low and the last time it traded lower? It's this guy. Okay, you're going to take the difference between the two and you're going to add it to the low. Made a mistake there. Glad I caught myself. You're going to add it to the low because these levels are going to become your resistance levels on the way up. If the marketplace cannot, break these points, and we're going to be showing you on a subsequent video again what to look for, the tracking between. You can basically take a low risk sale expecting the marketplace to come down and trade lower. Now, here's the thing. Once you break the 100% or the 1%, okay, this scale is no longer good. You have to basically go reset this. So if you make a new lower low where you break through your 100%, you make a new high where you break through your 100% up top, you got to go to that point that you just made, go to the left to the last time you traded higher or the last time you traded low, and do this whole scale all over again. So it's real important as traders to keep in mind one set method of doing things, because if you're doing it the proper way and you're doing it just like an institution does it, okay, you're going to basically see the marketplace like an institution sees the marketplace. And that's real important because we're all battling against the big boys, okay? So you want to really be looking at what they're looking at. The second thing is if you keep one mythology and you just keep doing it, okay, and you do it one set way, you're going to be able to find out what part of your system is making mistakes. If you're haphazardly just doing things without, every time you do a Fibonacci retracement, or every time you do pivot calculations, or every time you do a certain method, you're just doing it differently every time, you don't really know where, there's a weakness in your trading system. So it's real important to constantly keep doing things in one set, method. Okay, and this is the method that the banks do it. Okay, it's really simple, and I'm going to show you on a subsequent video. So if you're a newbie and you made it this long, congratulations. I don't mean to banter on, but I'm going to see you on that subsequent video, and I'll show you exactly how to put all this stuff together. And then on a next video, what I'm going to do for you guys is I'm going to get back on this whiteboard again, and I'm going to talk to you about a catapult system. Now, it's not the catapult for 80. It's really a Fibonacci catapult that I call it. Okay, it's a trading system that I worked on with a guy in Citibank way back when. It's really cool. It's a neat idea that we can really use with Fibonacci ratios. So I look forward to seeing you guys in a little bit. I'm going to go over with you some really good techniques to help move your trading forward. The techniques that I'm about to give you guys today will be one on the Fibonacci ratio. So we're just sticking with the lesson that I gave on the whiteboard. I just want to make it up close and personal so you can actually see it. Now I got those ratios up there, so let's grab a pen and a paper and let's write these down and make sure that we have them. And we're going to take you step by step on what exactly to do with these Fibonacci ratios. Okay, and I'm going to go over in detail what I was talking about on the whiteboard. Okay, so we're going to go over the Fib ratios that you need, which are right there up on the screen. Get that pen and paper, get your notebook out, put trading on the outside of the notebook, so when you find cool techniques, you can just add it to that book. It'll be like your little beginning of your toolkit if you don't have one already.
The next thing we're going to do in this video is I'm going to explain to you the proper way to draw your Fibonacci retracement levels on your chart. Okay, we're going to go over a daily. We're going to go over hourly charts, all the same. You apply it on hourly, daily, 15-minute chart. Let me shut my Skype off right now. This way we don't get those guys coming back and forth all the time. And the third thing that we're going to go over what I call up close or down close filter. Okay, I'm going to talk about whether or not if a bar has an up close or a down close, what we should be really looking at as we pass through a Fibonacci ratio. I'm also going to go over something really cool, part of a top lock, bottom lock type of trading technique that is really cool as well. So there's 4 in there for you. So make sure you grab your pen, a notebook, and let's take some notes. In my 3 years of interacting with retail traders, that's you guys, I found that as with the construction of trend lines, the application of Fibonacci retracement levels is really like a subjective process, and traders will invariably select highs and lows based on what they perceive to be important price levels. So it comes really as no surprise that different peaks and troughs have various importance depending on the role of the market participants. Now, I'm going to teach you guys a way that the banks and institutions look at the marketplace so you can see the market unfold the way that they do. Now, this is a great perspective to have, and it's going to give you an additional edge in the marketplace, and that's really what we're looking for. We're looking to gain an edge, and any way we can gain that edge, and this technique will actually help you do that. So, a lot of other people, I see in the retail world basically talk about, markets that are in, range-bound markets. They're not deliberate markets. I never heard this term before, deliberate. They say, stay out of those marketplaces. Only try to trade, when the market's really trending. Well, the only problem with that idea is that you never know, when the market's going to change from range to trend, and you got to be in that train before the train moves. As a trader, you have to be ready to pounce, and get involved in a low risk trade. And these techniques are going to do that for you. They're going to be able to teach you how to look at the marketplace and how to, actually you can place orders with these techniques, and you can go about your daily, live. You don't have to watch the marketplace 24 hours, a day like I do. You can actually have a life, so you'll be able to use these techniques to actually place a standing order. Like if you believe the marketplace is, going to come down, you could place an order at a fib level with a decent stop loss here, just in case you're wrong. You need that escape hatch to protect your capital, and you may get hit, come back, find your account up 4%, 5% because you did the right thing, which is what we're always looking to do. So here are our Fibonacci ratios. Now, for you guys that are advanced, please bear with me, because what I'm going to do is I'm going to really go over stuff for people that aren't as advanced. So I'm going to talk about what a bar chart looks like, the open, high, low, close, that type of thing, to make sure everybody's on the same page. I'm going to show you, where you put these numbers in, your tool. Now, if you're on MT4 platform, it's a little bit different than this platform. You actually have to go into properties, hit Fibonacci. You put the thing, you put the range up, the tool, then you hit properties, and you can change these. Now, again, the 2.236 is going to be standard. The 0.382 is going to be standard. The 0.618 is going to be standard. The 50 is going to be standard. This is the change. Instead of 0.786, use 0.82. Then 100%, 1.00, 1.382, 1.618, 1.82. 2.236, that magic number I was talking about before. I'm going to show you. We're going to pick a point on the chart just to see what happens at this level. This is an incredible level. Why it happens, I don't know. It's one of those mysteries of life. I just know that things happen there, and I'm always I'm always watching a marketplace when it's it's going parabolic and it's zooming towards this number, either up or down. 3, and then 5. So hopefully you got your notebook out and you wrote these down. I'll give you a couple more minutes, and we're going to talk about a bar chart, so we'll just leave that right there for now. A bar chart is the same exact thing as a candle chart, candlestick. The only thing that they do with a candlestick is they actually just, well, let's first go over a bar chart. Let's open this chart up and let's just do the anatomy of a bar chart just so that we have it. Where did my little thing go? Let's put that back up so you have it, okay? Obviously, this is the high of the bar. Okay, this is the low of the bar. What's the open? It's this little dash on the left-hand side. This is where the bar opened at. The market came down a touch, and then bang, it powered up and made this new high here. Okay, it's a green bar because it's an up close. What does that mean? Well, this is the open of the bar, and the market closed here. That's the close. Okay, so the open is greater than the close, so therefore it's an up close, and they paint the bar green. That's it, real simple. On this bar here, this is the high, this is the low, this is the open. Okay, right there was the open, and that's the close. It's a red bar because the close is less than the open. Simple stuff. So this Japanese candle would have been like painted, like if you just take this square, you take the open, you connect it to the close, and you paint it red. Because all they're really doing with a Japanese candle is they're just engulfing the open and the close, and they call this the wick, right? I don't know. I mean, I don't do anything with Japanese candles. I was always bar chart or X's and O's, that type of thing. So I never really, traded with them. I don't really have anything really against them per se. It's just that for me, this is cleaner, easier to see, and I don't need all those different colors. I don't need the body filled in. So that should have given you enough time to get a book out, write this down. Okay, now what we're going to do is we're going to just minimize that, and we're going to basically start with what we were talking about on the whiteboard. Now, this is a 1 hour chart, so let's just go to the daily charts. Let's just pop into dailies. Okay. And here's daily charts, 3 months worth of data. Okay. What a nice move down, huh? Okay. Let's just truncate this a bit and take a look. Okay. So let's just start from this point. This is what I was talking about on the whiteboard was, okay, if we have, now this is a daily chart, so if we have a new high that's made, now how do we know that it's a new high? Well, after this day closed, this gave us confirmation just from this day that this pivot point basically is in. Now, will it stay in? We don't know until tomorrow, and this marketplace could rally up and create another, supply point. So, actually, this is a supply point. Sorry, not demand point. This pivot point here is known as a supply point, right? And let's just take a little red guy here and just mark it, right? Just so you know what we're talking about. Okay, this new high is in, okay, and how do we know? Well, this high is greater than this one, and it's also greater than this one after the day closes. That's the only time we really can mark this as a pivot point, because this has to close. If when this marketplace opened, we didn't know if the marketplace was going to zoom up and create another, higher high here, and then we'd have to wait to see the next day if that is the true high. So we need a close. Okay, we need to know when it closes, right? Now on an hourly chart, obviously it'd be in 2 hours later. On a 4 hour chart, it would be 2 sessions later. Okay, so that's when we know that our point's in. Now this is working from a high. Okay, so when we're working from a high, all we have to do, okay, now is let's just truncate this some more. Make it a little bit, bring it up to the middle. Okay, we're working from a high. We want to go back in history. We want to go back to the left to the last time the marketplace traded at the same price or higher. And we find it right here, right? We could even, use that point. It doesn't really make a difference, but we found, I like to stay with, supply points to supply points. So that's the last time the marketplace traded at the same price or higher. What is the lowest price in between this point and this point? Well, I'm looking very simply, it's this low. Right there. So this becomes the price that we're interested in measuring. We're right now figuring out what's the true leg, what's the true most volatile leg that we have. Well, this is it. because we came from this point and then we did all this. We tracked and we were making actually, we started making higher bottoms here, and the marketplace is getting bid over here, it's getting strong here, So we want to see what the support levels are going to be from this sell-off. If the marketplace is truly going to reattack this high, it will use the Fibonacci ratios that we find from this whole leg. It will use them as support levels, and we're going to put those up and we can actually see what it looks like. Now, it doesn't matter that this has already happened, but you have to understand is you can go back, and this is what I want you to do. I want you to go back on your charts, constantly keep doing this so you can actually see the validity in these levels. It's so important for you to understand how powerful they are. I mean, it's uncanny how accurate they are. Now, this is the way that institutions look at the marketplace. Some guys might just want to measure this. Okay, well, you can do that, but the true way that big boys are looking at, they really want to know what's happening off of this big leg. Okay, so again, once more, you have this new supply point that came in, right? It's a high that's surrounded by two lower highs. Okay, so what you want to do is you want to go back in history to the left, find the last time it traded at the same price or higher, and then look, what's the lowest point in between this one and this one? Well, that's it right there. Okay, so what we're going to do here is shut off our arrow. What we're going to do here is just delete the arrow so it's not in our way. Delete the arrow. Okay. Truncate it. We're going to take our Fibonacci tool and we're going to measure. We want to throw this down. So the way that we would do it, okay, the way that we would do it by hand is we would take this high of 145.50 minus this low of 138.37. We would take that difference, get the pip difference, and multiply by those ratios that I gave you. 0.236, 0.382, 0.618, 0.5, 0.821, so on. And then what we would do is once we got those factors, we would just subtract it from the high. But we have a Fibonacci tool that does that for us, saves us some time. So we'll just take this high and we'll throw it down to here. Okay, let's shut off our, something's wrong with my Fibonacci tool, we'll figure that in a second. So if you have this, now on this platform, what you would do is you would show properties, okay? So here they are. Now, it's making them, it's moving the decimal over 1, so instead of 0.236, it's going 23.6. It's okay, same thing. 38.2, 50%, 61.8. This is supposed to be 82, and I don't know why it didn't do that. So 82.00, okay, 100, 1.382, 1.618, 182%. Okay, that's an extra level you can throw in there. Did I give you that level? I think I did. Yeah, 182. 2.236, that's actually 2 point, but they make it 223.6. Okay, 300 and 500. Okay, set as default, apply it, kablamo. Okay, so here's our range, right? Now this is the daily stuff, right? Now, you could do this. What I would suggest that you do is that you actually, on a daily chart, you actually do this. Is you write these levels down in, on your trading diary. You should have these levels. So you should know that you have a 23.6 at 143.80. Okay. You also have, 38.2 at 142.76 and 50% at 141.92 and 61% at 141.08 and 82% at 139.64, and there's the 100%, right? That was the low that was made, and then the market started tracking around. Now, let's just do this. Marketplace the next day starts breaking down through the 23.6. Okay, terrific. So it's showing some weakness here. Okay, let's just move it forward. I want you to take note. The next day, the market came up. It touched this. It touched the 23.6, and then bang, it powered down right through the 38.2 or 0.382%. Now, what we're really interested in is the tracking between the 618 and the 38.2. Okay, so this is really what we're interested in. Now, we're trying to see what's going on as a marketplace. What is it whispering in our ear? Well, now notice how it plays around the 0.382, which is really important. So the marketplace came down, it powered through here. The next day, it gave traders an opportunity to sell up in this level, and then look how it uses this level as support, the 618. Just amazing how it bangs into it, comes right back, closes right there. Now, I'm not going over any technique here. I'm just trying to get you guys to see how valuable these levels are. Then you got that gap. How was the gap open and down? Bang, we blew through the 618. Well, where we're heading? Well, we're definitely heading towards the 82. Now look at this. Huge move. Right back up to what? The Fibonacci level, 0.382, and then gets smacked right back down. Where? Very close to the 0.82. And there it goes. Okay, then the market went parabolic down. Okay, so just showing you how these levels are actually, uncannily accurate. Okay, and we're going to talk about in a little while, how we can use these levels on a 4-hour chart or 1-hour chart. What we want to do as traders to take advantage of these Fibonacci levels. Okay. Again, some traders say, well, this was like, just in a range-bound market. Well, you know what? Terrific. It was in a range-bound market, but if you had your Fibonacci levels up, all right, now we would have had a different, actually we wouldn't have. We'd have had a very similar level here. We had a top here, we went to the left, we found this point. So if you would have drawn the Fibonacci retracement from this to this low, these levels would be very similar. Okay, and you can see how you gain support here. Popped back up, came back up here. So you could actually have traded this range with very low risk. A few days later, you could have said, okay, the market held this, demand point here. I'm touching this fib level on a daily at 140.105. Where's my stop got to be? It's got to be like 140.50. So you're looking at 60 pip risk on a daily chart. And you got a nice rally up. 143 almost. So this will definitely help in what these people call, I don't know, range bound. This is basically a range. I call it a range bound market for a few days, and then finally broke out of the range. Some call it, I don't even know the terms that they use. They use stuff like not deliberate or something, an undeliberate market. Never heard of it before. Doesn't ring a bell to me, but range bound market definitely does a bell. Well, and I'll talk to you guys in other videos how you can actually trade a range bound market. But really, daily type of bars are, they're big ranges, so needs a real big account to mess with them. But this is how we would do the Fibonacci ratios off of the daily, okay, from this point, okay. Now, guess what? Let's say, for instance, I want to just delete this, okay. We find this low, okay, and we want to go back in time to the last time that this marketplace traded lower or at the same price. So if I just put my little line up over here, if I take my arrow, and I want to go to the left, and I want to see what last time this marketplace traded at the same price or lower. And that's right there, right? Fine, close enough. What's the highest point in between this point and this point? Well, it's that one. So now, if we're expecting the marketplace to kind of do, a little bit of a rally, and we want to see where resistance is going to be. Remember, this we were looking for support to see if it was going to hold, and it blew through the levels. It was breaking down. Okay, if we want to see where resistance is going to be, well, we're going to just take our tool and do the opposite. Okay. Let's delete this. I'm going to come up. Okay, so we have this on a daily chart. We can say, you know what? I got to see what happens. If the marketplace gets up to 138, I want to see what's going on, because now I'm breaking through the 236. I got my 0.382 up here at 140.43, and we got the 618 way up. So let's just see. Again, this is not showing you technique. It's just I just want you to see how accurate the levels are. So look at this. You made your spike up above the 23.6 on a daily. Okay. Now you're coming back off. And you broke down again. Lower. And here, this is exactly where the market is right now. So really what we'd have to do is we'd have to go back. If we started from this point, let's say we didn't take that high, right? We can delete this. We would be using the deeper levels of this range. Okay, so we'd be looking for the 2.236. Let's just do that. Let's put this up. Okay. And let's shut this off so it doesn't draw another one. Let's bring this up here so we can see it. Here's the 161.8. Here's the 182. We haven't extended down to the 2.236 of that move yet. Yeah, 2.236 right there. Okay, hasn't gotten there yet. We're still messing around with the 161.8 and tracking between the 138.2. So that's where the you use your additional expansion levels here. You found this. You went over, you said, where's the resistance going to be? Well, it came back up. If you didn't use this point, okay, if you just came in and said, I want to see resistance levels. Well, all right, let me see where the support levels were supposed to be off of this peak. Well, they should have been here. And you blew right through them. Notice how the market just tracks through these. It's just incredible, how this works. All right, so let me pause this, get a water. I'll be right back. Okay, so let's shoot over to the 1 hour chart. And as you can see, the daily comes out on the 1 hour, which is okay, but you can do that if your chart does, it's great. If not, I would suggest marking down those levels in a book so you know exactly where they are. Okay, so let's just get rid of this stuff. And we'll go from our current position right here. So remember, what we're just doing here is we're just learning how to properly apply these Fibonacci ratios, okay? And, you could basically go from this most recent supply point that you have. It's a high surrounded by two lower highs if you want to look to see where support's going to be. Because we made this low, okay? So the marketplace basically is saying itself, it's consolidating a little bit. Doesn't know what it wants to do yet. But these ratios are definitely going to be help us do this. So what we want to do with this is from this point we would go to the left to the last time it traded at the same price or higher, and we'd find this point. Okay, well, what's the lowest point in between this supply point and this supply point? Well, it's this demand point right down here. Okay, so what we want to do now, if you want to do it by hand, you would take the difference between this high, which is 135.43, and this low, which is 133.63. So it's 100 pips, obviously, right? A little bit more than 100 pips. So you would just take that difference and then multiply by the fib levels. But we have our tool, we have our trusty tool. So we could just pull this down, and it does all the math for us. We don't have to worry about it. So here we are. These should be support levels for this move. Now, you see how we spiked through the 618, came back up, and we're messing around, and we're powering back down through. So these are the levels that you'd want to be looking at. Now, what does this do for you? And why would you need this? Well, obviously, this gives you, an ideas. I'd say, for instance, you think up for whatever reason. You have a trading system that thinks up. Well, most likely what you'd want to try to do is you want to try to buy back down at the 134.32, or you want to buy back down at 134.55-ish. Okay, now you're 10 pips away. So, well, what if I never make it? Well, you're powering down through it right now if you wanted to go long, right? So what you can do is you scale into your trade. Scale in. So I'm just making up numbers here because it all has to do with what your account size is, and that's a lesson completely different. You should only really risk 3 to 5%. The 5% is really being a gunslinger of your account size per trade. So if you got a $5,000 account, you're looking to risk really $250 on a trade. Okay, now some people say, oh, but that's really the math. Okay, that's really what you should be doing. If you got a $10,000 account, it goes proportionally. You want to risk $500 on a trade. $100,000 account. Okay, well, you risk $5 grand. So it all has to do with your account size. So scale in. Let's just say you could buy 300,000 units of something, because if you know what your fixed stop loss is, say 60 pips, and you could afford that. Okay, but you're not really sure. Now, this is just a scenario we're making up so we can hammer the point home. You're not sure you're going to make it down to 55. You're getting anxious. What if it doesn't go to 55? I'm 10 pips away from, or 8 pips away. Okay, so buy 1/3 of what you could do. You buy 1/3. Market comes down. It comes down to the level you want to buy at, and you say, ooh, maybe I was a little early. So you buy another third. Don't buy the 2/3, you buy another third. So now you got 2/3 in. Now all of a sudden, you're coming down to the 618, and you say, well, this is really where I really wanted them. So you buy your last 1/3 down at this level. Okay, and if you are correct in your market analysis, and the market starts powering up, well, you're basically in at an average. You didn't get them all here, but you were real anxious, and you didn't buy them all up here, and the market place came down on you and actually caused you some a little bit of frustration. So you basically scaled in. That's called scaling in. Instead of buying all that you can do at once, you do pieces. Okay, and you have your ultimate stop loss. So you're averaging in, your cost averaging, all with a plan. This is not like I'm buying this here, oh, I'm out of the money, I want to buy more because I think it's going back the other way and I'm going to make all my money back and more. No, this all has to be pre-planned out. You know what your stop loss is, you know what your risk is. You scale in because you're not sure you're going to make it down to your ultimate target where the marketplace is going to come to. I mean, if I could tell you, marketplace is going to come down here, and you can buy 133.96, and then it's going to rally back up over here at 135.02. Well, that's just reading a crystal ball. Nobody really knows if we'll totally make it. Sometimes you can nail it perfectly, but there are other times that you can't. So scaling in, it's another little lesson for you. Scale in. Okay, hang on a second now. Let's delete this. All right, so we found this top, right? Supply point, it's a high, surrounded by 2 lower highs. Here's a demand point, right? It's a low, surrounded by 2, well, not yet. We don't know if this is going to close here. We have no idea. But let's use here's a demand point for sure. It's a low, surrounded by 2 higher lows, okay? Low, surrounded by 2 higher lows. That's how we know. So we went to the left. Last time it traded higher or at the same price. Then we found this point, and we pulled our Fibonacci scale down, okay? Those levels should represent support if this top is eventually going to be taken out. Okay, so that's what we did. Now let's just go do one for resistance. Okay, let's find resistance. So we have enough data here. Wow. Hasn't been this low in a while. Let's see if we can get 6 months, a year of data. We're really crunching this up, huh? We haven't been down here, I think, since June or something like that. So let's go back. Okay, here we go. All right, so look. Nope. It's here. Okay. All right. So we want to find resistance. Now I know I crunched this all up and we're going to fix it, but it's just to show you really what we're doing here. This low point that we're going to expand out, we're going to go to the left to the last time that the marketplace traded lower or at the same price. We find this big glob of stuff right here. And what's the highest point in between? Well, it's this 149 something, almost 150, 149.40. Okay, so we want to pull our, even on the hourly charts, the scale is going to be large because the move itself, we haven't been this low in a long time, way back in February, what happened, right? So we want to measure that. All right, so what are we going to do? We have to open this up, so we can see it better. This is the low we were talking about. And we want to go up to, 149. And find that bad boy. Then we'll expand it out once we find it. Okay. Oh, there we are. No, it's the 146. Oh, there it is. Right there. Okay, so we want to take this tool. We'll fix it because we can get the top and bottom, and then we want to do this. Close enough. Okay. Let's get rid of that. Let's come on over and open it up. So really, the upper range on this 1 hour is way up here at 137. Okay, that's really of no real use to us, but it's the true, resistance level. And you can see. So what would we do with this? Well, we would do exactly what we were doing before. We have the main level that we just found. Now we can find an internal level, okay, shorter term level. We know now that's the main level off the hourlies. I would really want to see what happened on a daily, if there's a what we call confluence of points, if a daily level falls here, But right now what we could do is from here we'd say, all right, well, that's the true, resistance level way up there. Let's see how it's working on the support, exactly what we just did before. We went to the left and we threw it down, right? So do I still have that plugged in? No. So basically here I am, and I got this level here, okay? Now that's really what we need to work with on the hourly charts, okay? Now we could say, all right, look, we're breaking down. If we blow through this level, based off of this last leg, we can use the greater extensions, which is all we're interested in. We're really interested in, this is just for short term, right? So we're really interested in these greater extensions. So that's how we do true Fibonacci retracements, okay? And I'm going to go over with you. Okay, let's just leave this right here, okay? Now I want to go over with you basically the other couple of points that I was talking about, the trading tips that I was talking about. And these are some of the things that you have to keep in mind when you're looking at these Fibonacci levels, scale levels, okay? And real short-term technique, all right? And let's just use this hour, okay? Let's just use this hour. Let's say we were on this hour. Okay, let's open it up so we can see it better. Okay, we just make it really big. Okay, let's say the market just closed on this hour. Okay, what kind of close is this? This is an up close. This generally means that there's a lot of traders that have, bought this marketplace. There's a lot of people that are long. So once you jump through, once you break a Fibonacci level on the opposite direction, you could probably be, rest assured, it's going to be a pretty powerful move because a lot of people are caught long. Okay, they're all long thinking higher. Once this marketplace reverses back down through and you go through your 23.6, what you could do is you could say, okay, I'm going to sell 23.6, stop loss 2 pips above this high because I have an up close. And then I'm going to try to power down and try to break down, through my other fib levels. Okay. That's just one short-term technique you use. So you get an up close, next bar opens up and starts breaking down. We can remember this is an up close, so a lot of guys are long and ladies, so they're probably going to want to get the heck out of this thing. They might have bought the open. They don't want to give back their profits. So that's actually going to help power this move down. Okay, and on your next, this is the next current hour right now. You have a down close here, right? So you'd probably, the way I would look at this marketplace, I'd want to see it. I bet you this level holds. Because a lot of people, have sold all this. And some new participants came in too. And they don't want to give back their profits. Okay? So you can actually watch these levels. They should act as pretty decent support right now. Or if it comes down here and you can't break it, all right, you'd want to escape the short that you took here, at one of these levels. Okay. Now, obviously, if the marketplace is going to retrend and start pushing down longer term, then you're fine. But this is just a neat little trick. It's called up close, down close. So if you have an up close and you're breaking down through a Fibonacci level, most likely, you could probably short this and put your stop loss like one tick, a couple of ticks above this old high, and you can try to play these ranges right here. So that's the up close, down close idea, and I'm going to go a little bit more in detail with that using what I call top lock, bottom lock in a second, which is a secondary technique. So let me just get another water, and I'll be right back. Okay, so the up close, down close idea, looking at that when you're breaking through, you had an up close the bar before, so most likely the move could be pretty powerful because people are going to want to escape the trade. Now you got, look, just noticing, since we have a down close on this bar, look how the marketplace is really fighting at this fib level. So these are the things I want you to keep in mind when you're looking at Fibonacci levels and you're looking to enter a trade. There you go, you got an up close before. Wow, if I power through this, I could take a short, looking to get down to this fib level, or now I can cut half my trade off, let the trade run. Next important point using fib retracement levels. Once you define your marketplace, you found this point, you went back, you found the lowest point in between. I want you to, this is a great idea, I want you guys to look for the first close. When you go to the bottom, when you find your bottom point, I want you to go to the first time that you have a close that's greater than all 4 previous closes. So look, this one, this close is greater than this one, it's greater than this one, 2, it's greater than this one, 3, it's greater than this one, 4. This close is greater than all 4 previous closes before it. For me, this is like a demarcation point. This is a line in the sand that I just want to put a line. I want to put a horizontal line on the bottom of this bar. Now it's actually resting very close to this Fibonacci level. So if this marketplace does get down through this and break this, for me, this is an indication that this downtrend will resume in power. So this is a way that you could say, non-deliberate market or whatever they call it. This is a way of actually triggering a means of getting into a trade because for a trend continuation. If this breaks, the trend should continue. The trend's been down, should be a powerful move, start of another power leg down. Okay. Also, when you have the top defined right here, what you want to do is you want to look for the first close that's less than all 4 previous, which happens to be 1, 2, 3, 4, and you want to put a line up there. Okay, you want to demark that line right there. That point for me actually should have been. Got the other traders in the background. That point right there is the demarcation line of power up. Now, look, we spiked it, and it didn't hold. It came right back down through it. So this would have been a level for you to look at. It's not holding. Market's getting weaker. Can sell it. Same type of thing. All right, I'll see you guys on the next video. I hope that was a big help to you. Any questions, you can email me. I'm here to help you out. Cheers.